Merck just delivered one of those classic mixed bag earnings reports. The headline numbers look great, but underneath, there is a real fight going on between the company's presiding star drug and the parts of the business that are starting to slow down. Second quarter sales came in at $15.8 billion, and adjusted earnings per share hit $2.13, both ahead of what Wall Street was expecting. Merck liked the results enough to raise its full-year revenue guidance, now expecting somewhere between $66.3 billion and $67.3 billion for all of 2026, up from its previous range. At the same time, though, Merck actually cut its full-year profit guidance because of an accounting charge tied to a biotech acquisition it closed back in May. Start with the good news, because there is a lot of it. Keytruda, Merck's blockbuster cancer immunotherapy, and still the best-selling drug in the world, generated $8.37 billion in the quarter alone, up 5% from a year earlier and comfortably ahead of the $8.27 billion analysts expected.
This is Conference Hype. Stay with us, coverage continues.
A big piece of that growth, $463 million worth, came from a brand new version of the drug, an injectable, under-the-skin formulation that patients can receive in minutes instead of sitting through an intravenous infusion. That new formulation matters enormously for Merck's future, because the original intravenous version of Keytruda is set to lose patent protection soon, and the company is racing to shift as many patients as possible onto the newer, patent-protected shot before that cliff hits. Now the parts investors are watching more nervously. Gardasil, Merck's HPV vaccine, and once one of its fastest-growing products, saw sales fall 22% in the quarter, dragged down by weak demand in China and Japan, two markets that used to be major growth engines for the shot. Merck's animal health business, by contrast, held up fine, with livestock and companion animal products both showing steady demand. The profit guidance cut comes from Merck's acquisition of the biotech Terns Pharmaceuticals, which closed in May and brought with it an experimental treatment for chronic myeloid leukemia. That deal is part of a broader shopping spree Merck has been on to build life after Keytruda's eventual decline. In recent months, the company has also picked up Ohtuvayre, a respiratory drug for chronic obstructive pulmonary disease that came through its acquisition of Verona Pharma, and struck a partnership with the biotech Sedura around a late-stage experimental flu treatment. None of these new assets are anywhere near Keytruda's scale yet, but they are the clearest signal of where Merck is trying to point its growth once its current cash cow eventually starts to fade. That is the story of Merck Q2 2026 earnings, Keytruda growth versus Gardasil decline. Add your perspective in the comments, share this story with a colleague, and subscribe for the next Conference Hype narrative.